Imagine you wake up on a Tuesday morning, right? You log into your retirement account, and you realize you're suddenly 20% richer than you were just a few months ago.
Oh, which is the best feeling.
Right. You feel great. You feel like you've got all this momentum. But then, on your way home from work, you stop at the grocery store.
Yeah, reality hits.
Exactly. You find yourself standing there staring at a package of ground beef, and you're mentally calculating if you can actually afford to make burgers tonight. Or if you need to just put it back.
It's wild.
Welcome to May 26, 2026. The economy hasn't just shifted, it has literally split in two.
It's the ultimate cognitive dissonance, honestly. And, if you're listening to this and feeling that whiplash, you aren't crazy.
No, not at all.
We are looking at a financial landscape right now that just completely shatters that old assumption of a rising tide lifting all boats.
Right.
Instead, we have these two completely different realities, and they're operating in the exact same physical space.
So today, our mission on this deep dive is to map out that massive, undeniable fracture in the global financial ecosystem.
Yeah, because we have to figure out how this is happening.
Right. On one side of the ledger, we are riding this unprecedented multi-trillion-dollar technological supercycle, just defying gravity. But then on the other side, the everyday consumer is facing a brutal, honestly suffocating economic reality.
Right.
We need to figure out how these two extremes are managing to coexist without the whole system just, spinning off its axis.
Because the physics of finance tell us that this kind of tension, it just can't last forever. I mean, something eventually has to give.
Okay, let's unpack this. To figure out what that something might be, we've brought together a really fascinating stack of sources for you today.
Yeah, a lot of ground to cover.
We're pulling from post-holiday market wrap-ups from Bloomberg and Charles Schwab. We're also breaking down some really detailed economic analyses from Penn Mutual Asset Management and Zacks Investment Research.
And the big one, the SpaceX filing.
Oh, yeah. We are going to tear into the S-1 filing for the impending SpaceX IPO, which is, frankly, one of the most mind-bending financial documents I've ever read.
It really is.
And finally, we're tracking the geopolitical updates. They're completely reshaping the global energy trade right at this very moment.
So it's a massive web of information, but there is a very clear, very stark through-line connecting all of it.
Let's start by looking at what happened right after the Memorial Day holiday. The market reopened, and it didn't just inch upward.
No, it launched.
It absolutely launched. We're seeing the S&P 500 marking its 8th consecutive positive week. It hit an all-time high of 7,519.
Wow.
The NASDAQ set a record at 26,656, and the Dow Jones Industrial Average just shattered the historic 50,000 threshold. It's currently hovering just slightly down from that peak at 50,461.
So let's put that Dow 50,000 number into historical context, right? Because the velocity of this wealth creation is just staggering.
It's hard to even process.
Right. So the Dow was launched all the way back in 1896 at just over 40 points.
40 points.
Yeah. And it took roughly 76 years until 1972 to cross the 1,000 mark.
Yep.
Then it took the absolute mania of the 1999 dot-com boom to hit 10,000. We finally reached 40,000 in 2024, which was, driven by the post-pandemic recovery.
Right.
And now, just 2 short years later in 2026, the market has casually bolted on another 10,000 points.
Just casually.
We are witnessing nominal capital accumulation at a speed that traditional economic models just they struggle to even chart it.
Yeah, velocity is the perfect word there. Looking at these charts, the stock market feels like one of those experimental high-speed magnetic levitation bullet trains.
Well, that's a good way to look at it.
Right. It's hovering above the tracks, frictionless, moving at breakneck speed. It looks like something out of a sci-fi novel. But then if you zoom out and look down the track, you realize something kind of terrifying.
Yeah.
That beautiful maglev train has completely decoupled from its passenger cars. The engine is just flying toward the horizon on its own, and the passenger cars, which represent the real everyday economy, everyday people, they're just coasting to a halt, stranded miles behind.
That visual captures the data perfectly. The engine of this market is utterly insulated from the passengers.
Right.
If we open the doors to those passenger cars and look at the survey data, it's genuinely alarming. We just got the final University of Michigan Consumer Sentiment Index for May, and it was revised downward to a record low of 44.8.
A record low. That's down from roughly 50 in April. And for an index that historically moves in these tiny fractional increments, dropping 5 full points in a single month is, that's a structural collapse.
It's a klaxon horn going off. To understand why 44.8 is such a flashing warning sign, we have to look at what was happening the last time sentiment was anywhere near this abysmal.
Right.
And that was in June 2022, when the index sat at 50.
Okay, so what was the market doing then?
Well, what was the stock market doing in June 2022? The S&P 500 was in a brutal free fall. It ended up losing 19% that year.
Right, I remember that.
Back then, consumer misery and stock market performance were tethered together. When the consumer felt pain, corporate earnings dropped, and the market felt pain.
But not today.
No.
Today, the consumer is in significantly more pain than they were in 2022, yet the S&P 500 is trading above 7,500. So what is actually driving that consumer misery?
It comes down to the absolute erosion of purchasing power. According to that University of Michigan data, 57% of consumers are spontaneously mentioning, meaning they aren't even being prompted by the survey questions, they're just bringing it up, that high prices are actively destroying their personal finances.
Well, unprompted.
Yeah. Inflation expectations for the year ahead have surged back up to 4.8%.
Jeez.
To put that in perspective, before the geopolitical conflicts really escalated, we were sitting at 3.4%. So the cost of living is fundamentally eating away at real wages.
Which bleeds directly into how everyday retail investors view this record-breaking stock market.
Exactly.
The American Association of Individual Investors just released their weekly survey, and 43.6% of individual investors are currently bearish. Only 31.7% are bullish.
Yeah.
So you have a scenario where the market is hitting all-time highs, yet the people actually living in the economy are actively betting against it.
And it makes complete logical sense from their perspective. I mean, they're positioning their portfolios for a correction because their daily lived experience contradicts the financial headlines they see on television.
Yeah, they don't trust the rally.
Not at all.
If you're listening to this on your commute right now, you're probably nodding your head. This great divergence explains why your weekly trip to the grocery store feels incredibly painful, why paying your utility bill makes you wince, but then you check your 401k balance on your phone, and it looks absolutely fantastic.
Right.
Your retirement account is riding in the engine of that maglev train, but your checking account is stuck in the stranded passenger car.
Which forces us to ask the ultimate macroeconomic question. Historically, consumer spending drives about 70% of the United States economy.
70%, yeah.
So if that consumer is historically tapped out, terrified of inflation, and actively pulling back on spending what is actually powering the stock market engine.
Yeah, who is laying down the tracks for this train?
Exactly.
Well, the answer to that is not the American consumer. The answer is silicon.
Yes.
We are in the middle of an artificial intelligence infrastructure boom. This is a trillion-dollar technological supercycle that operates completely independently of whether or not a family can afford a gallon of milk.
It's a capital expenditure cycle, unlike anything we've witnessed since the build-out of the global internet infrastructure in the late 1990s and early 2000s.
Right.
But the difference is it's being compressed into a fraction of the time frame.
To understand the sheer scale of the money sloshing around this space, we have to look at Micron technology.
Oh, yeah. Let's talk about Micron.
Micron just made a massive 19.3% leap in a single trading day, pushing its share price to nearly $896.
Wow.
This was ignited by an analyst upgrade from UBS, led by Timothy Arcuri. But he didn't just tweak his price target. He raised his 12-month target for Micron from $535 all the way to $1,625.
Which is, tripling a price target on an already massive established tech company is almost unheard of in traditional equity analysis. It's a wildly aggressive statement.
And because of that leap, Micron has officially tripled its stock price this year alone, and they just walked through the doors of the $1 trillion valuation club.
Insane.
They are now sitting at the table alongside NVIDIA, Apple, and Microsoft, companies that, by the way, have already blown past the $3 trillion mark.
Right.
But here's the thing I want to drill into. When most people think of AI, they picture the brain, the processors, the GPUs, the actual chips doing the calculating.
Yeah, the thinking part.
Right. But Micron doesn't make the brain. They make memory. So why is memory suddenly worth $1 trillion?
Because that is the crucial mechanical bottleneck of artificial intelligence. We often anthropomorphize AI, thinking of it as the thinking entity.
Sure.
But in reality, AI is just math. It's processing unimaginably large data sets at lightning speed to find statistical patterns.
Okay.
In order for an advanced GPU to do that math, the data has to be fed into the processor almost instantaneously. If the memory chips storing that data are too slow, the most powerful, multi-million-dollar AI processor in the world is just sitting there idle, waiting for information to arrive.
Oh, I see. It's like having a Formula One engine installed on a car, but the fuel line is the size of a drinking straw.
Exactly.
An engine can't do its job if it can't get the fuel fast enough.
That is exactly it. AI requires specialized high-bandwidth computer memory, specifically something called HBM, or high-bandwidth memory.
Okay.
Micron manufactures that memory, and right now there is an acute global shortage. The demand from data centers is so overwhelming that Micron possesses pricing power that traditional tech companies can only dream of. One of our sources from Zacks highlighted that historically Micron was expected to earn about $1 a share.
$1.
Yeah. Now, Wall Street is projecting they could earn $100 a share in just 3 years.
Wait, 100 times their historical earnings.
Yeah.
When you have exponential growth projections like that, it completely breaks traditional valuation models. People always ask, aren't these tech stocks in a bubble? But if companies' earnings are legitimately growing by a factor of 100, their high stock price is actually fundamentally justified.
Right.
But the silicon boom isn't just a domestic American story. The geopolitics surrounding who gets these chips is incredibly complex. We're seeing reports from Bloomberg News that Qualcomm just struck a massive deal with ByteDance.
ByteDance, the Chinese parent company of TikTok.
Right. Qualcomm is shifting its focus. Instead of just making the Snapdragon processors for your smartphone, they are supplying millions of AI-focused ASICs application-specific integrated circuits for ByteDance's data centers to power the AI software behind TikTok.
Yeah,
But let me stop you there, because my immediate reaction reading this was total confusion.
I get that.
ByteDance is a Chinese company. The U.S. government has massive, strict export restrictions explicitly designed to stop advanced AI chips from going to China. How is an American company legally selling millions of AI chips to ByteDance?
What's fascinating here is how geopolitical regulations actually dictate the physical architecture of computer hardware.
How so?
Well, the U.S. export controls are largely based on a metric known as compute density. Essentially, the government measures how much raw, generalized processing power a chip has and how fast it can communicate with other chips in a massive cluster.
Okay.
The strategic goal is to prevent China from acquiring sprawling clusters of generalized supercomputers that could be used to train cutting-edge military or strategic AI models.
Right. Those are the classic generalized NVIDIA chips that every tech CEO is currently fighting over.
Right. But Qualcomm isn't selling ByteDance generalized GPUs. They're selling ASICs.
ASICs.
Yeah. An ASIC is an application-specific integrated circuit. Unlike a GPU, which can be programmed to do almost anything, an ASIC is physically hardwired at the factory to do one highly specific task incredibly efficiently.
Oh, interesting.
It cannot be reprogrammed. In this case, these ASICs are likely hardwired simply to run the specific recommendation algorithms for ByteDance's consumer software, basically serving you the next viral video.
So because the chip is physically incapable of doing anything other than running TikTok's specific consumer algorithm, it doesn't trigger the national security thresholds designed to block generalized supercomputing power.
Precisely. Because it's purpose-built, it falls outside the strict parameters of the export controls. So ByteDance, unable to buy a few thousand generalized superchips, simply buys millions of highly specific custom-built ASICs to get their consumer job done legally.
I just find it profoundly ironic that billions of dollars of cutting-edge silicon are being deployed, navigating complex international trade law, all to ensure a teenager gets served a slightly more optimized video of a cat falling off a couch.
It sounds absurd, but the capital flowing into that optimization is very real. And this Qualcomm deal ties into a much broader, highly strategic shift in how global capital is moving.
Right.
If we look at the macroeconomic data for China, overall foreign direct investment, meaning money flowing from outside the country into Chinese businesses, just plummeted 57% month over month. It hit an 11-month low of just $5.6 billion.
That is a staggering drop in foreign investment. I assume that's the direct result of ongoing U.S. trade policies, tariffs, and the general push to move manufacturing to places like Mexico or Vietnam.
It is. Traditional multinational manufacturing is bleeding out of China to avoid those tariffs. However, there is a massive caveat hidden in the data. While overall investment is collapsing, foreign direct investment into China's high-tech sector is actually up 20% year over year. In fact, high-tech investment now accounts for 40% of all foreign capital entering the nation.
Wait, really? So people are pulling out their money for making plastic toys and cheap electronics, but they're doubling down on AI and advanced tech.
Exactly. It's a strategic pivot by global capital. Both Beijing and foreign tech investors recognize that the future of economic dominance doesn't lie in cheap labor. It lies in advanced manufacturing and AI infrastructure. They're taking a highly targeted surgical approach to global investment, entirely ignoring the broader trade tensions.
Okay, so we've mapped out the silicon boom. We have specialized chips bypassing trade laws, and companies like Micron becoming trillion-dollar titans overnight. But here is the physical reality. You cannot just plug a million AI processors into a standard wall outlet.
No, you definitely cannot.
If the consumer isn't driving the market, and Silicon Valley is designing the engine, who is actually building the physical tracks for this maglev train? Where does the digital supercycle spill over into the physical world?
This is where the story gets really interesting, because the digital world is slamming headfirst into physical constraints.
Right.
You cannot run an AI supercycle without vast, unprecedented amounts of raw electricity, water, and industrial materials. The unsung heroes of this stock market rally aren't the software developers writing code. They're old-school industrial manufacturers and utility companies.
The hidden beneficiaries.
Yes.
We have some fantastic insights from Greg Halter, the Director of Research at Carnegie Investment Council.
Sure.
He points out that while everyone is blinded by the flash of the mega-cap tech stocks, there's a gritty, physical ecosystem operating behind the scenes.
Very gritty.
Data centers are essentially just massive warehouses full of incredibly hot, incredibly power-hungry metal. They literally cannot operate without a reinforced power grid.
Power constraints are rapidly becoming the single biggest bottleneck for global AI expansion. It doesn't matter if you have 100,000 cutting-edge processors if the local utility grid can't handle the load to turn them on.
Right.
That's why we're seeing incredible momentum in unglamorous power management and electrical infrastructure names. Companies like Eaton, Vertiv, and nVent.
Tell me about Indent, because according to the notes, they are experiencing double-digit backlog growth, and they don't even make chips.
Right. nVent makes the foundational electrical enclosures, connection systems, and liquid cooling solutions.
Liquid cooling.
Yeah. An AI processor runs so hot that traditional air cooling, just blowing cold air across the servers with massive fans, it's no longer physically sufficient to stop the chips from melting. You have to use direct chip liquid cooling.
Wow.
The infrastructure required to pump engineered fluids through a massive server farm safely and continuously is a massive industrial undertaking. Cooling the data center is now just as critical and almost as expensive as powering it.
And then you look at the utilities actually generating that power. Names like NextAir Energy, Alliant, and Celestica up in Canada. But the one that really jumps off the page in our research is Talon Energy.
Oh, Talon, yeah.
The data shows that Talon Energy is dedicating 50% of its entirely new power generation capacity specifically to data centers. Half of their new growth is just feeding the AI beast.
It's massive.
And what's wild to me is the valuation. Unlike tech stocks trading at massive premiums, Talon Energy is trading at a relatively low 14 times forward price-to-earnings ratio.
Let's unpack that forward PE metric for a second, because it explains why institutional money is flooding into these utility stocks.
Yeah, you do.
The price-to-earnings ratio is simply how much you're paying for $1 of a company's profit. If a tech company has a PE of 70, you're paying $70 today for every $1 they earn.
Okay.
A forward PE just uses the projected earnings for the next 12 months.
So with Talon Energy at a 14 forward PE, it means for every dollar they expect to make next year, you only have to pay $14 today. It's a bargain bin price compared to a tech giant.
Exactly. It makes Talon Energy a classic value investing play, but it's wrapped inside a hyper-growth tech narrative.
Right.
Traditional utility companies usually target a slow, boring 2 or 3% growth rate per year, but suddenly you have tech giants knocking on their door offering to buy every single megawatt of electricity they can generate for the next decade.
Which is a dream scenario for them.
Oh, absolutely. For investors who are terrified that tech valuations are a bubble waiting to pop, these infrastructure and utility plays offer a backdoor entry into the AI boom with a much safer traditional valuation framework.
And the physical build-out doesn't stop at the power grid. There's another fascinating industrial indicator flashing bright green right now, and it is about as far removed from a silicon microchip as you can possibly get. I'm talking about rail yards. Greg Halter noted an unusually surge of bullishness on traditional rail stocks companies like CSX, Norfolk Southern, and Union Pacific.
Okay, railways.
Now, if the American consumer is tapped out and retail spending is collapsing, fewer goods should be moving across the country. So why are the trains doing so well?
This relies on a classic tenet of market theory. Stock prices lead fundamentals.
Right.
The stock market is essentially a forward-looking discounting mechanism. It tries to price in what the world will look like 6 to 12 months from now. If institutional investors are aggressively bidding up rail stocks today, it's because they're anticipating a massive surge in physical business activity and industrial demand.
They are betting that the hundreds of billions of dollars being committed to data centers, new power plants, and electrical grids are going to require immense amounts of heavy physical materials.
Exactly.
Talk about steel beams, thousands of tons of concrete, miles of copper wire, massive industrial cooling units. All of that incredibly heavy material has to be physically moved across the continent.
And you cannot move a massive power substation via a software update.
No, you can't.
And it's too heavy for a standard semi-truck. It has to go by rail. The surge in rail stocks is a signal that the industrial supply chain is gearing up for a historic build-out. It's completely bypassing the current gloom we see in consumer retail spending.
Right.
The rails are moving the concrete to build the data center, to house the servers, to train the AI. It's a fully interconnected physical supply chain supporting a digital revolution.
All right, so we've established the foundation of this alternate reality. We have the silicon, we have the power grid, and we have the physical transport. Now, let's look at the absolute apex of this entire supercycle.
The big one.
We need to talk about the ultimate mega project.
Yeah.
Because we've just gotten our hands on the detailed S1 filing for what is shaping up to be the most anticipated, the most heavily scrutinized, and arguably the most dangerous initial public offering in modern financial history.
Yeah, we are talking about SpaceX.
SpaceX.
They just filed their S1 document for a confidential IPO expected to list on the NASDAQ on June 12th under the ticker symbol SPCX. And the numbers laid out in this document are almost difficult to process.
Let's break down the sheer scale of what they are asking the market to absorb.
Yeah.
The target valuation for this IPO is set between $1.75 trillion and $2 trillion.
Yeah.
Trillion dollars with a T.
Which is, just to give that some context, only 3 companies in the United States currently trade consistently above a $2 trillion market cap: Apple, Microsoft, and NVIDIA.
Right.
SpaceX is attempting to walk out the door and join the most exclusive corporate club on Earth on day 1 of its public life.
And the lead underwriter managing this mammoth deal is Goldman Sachs, backed by a syndicate of 21 other major banks. Now let's look at the actual revenue generating this historic valuation.
Okay, let's look at the numbers.
According to the S1, SpaceX generated $18.7 billion in total consolidated revenue for the full year 2025. That's up a very healthy 33% year over year.
Not bad.
But the undisputed cash cow of this entire aerospace operation isn't actually launching rockets. It is Starlink, their satellite internet division.
Right.
Starlink pulled in $11.4 billion, which is 61% of their total corporate revenue.
And the underlying metrics for Starlink are a fascinating study in scale. The filing shows they crossed 10 million active subscribers. However, their average revenue per user, or ARPU, actually fell 18% down to $81 a month.
Which honestly makes perfect business sense. As they expand globally into developing markets in South America or Africa, they have to lower the monthly price point to capture market share.
It's the classic telecom trade-off.
Okay.
You accept lower margins per user in exchange for massive volume expansion. But let's do the math on that.
Okay.
10 million subscribers paying $81 a month is roughly $810 million a month, or just under $10 billion annualized. The fact that they reported $11.4 billion in revenue means they're making significant additional money from highly lucrative enterprise contracts, secure government and military deals, and the actual sale of the hardware dishes. Starlink is a very real, incredibly profitable, globally entrenched business.
It is. But, well, okay, here's where it gets really interesting. Because while Starlink is printing cash, the consolidated SpaceX company is bleeding cash at a rate that is truly staggering. SpaceX posted a Q1 2026 net loss of $4.28 billion.
Wow.
That is not an annual loss, that is one single quarter. And they currently have an accumulated deficit sitting on their balance sheet of $41.3 billion.
A $41.3 billion deficit.
Yeah. So the obvious question is, How is a company losing over $4 billion every 3 months asking for a $2 trillion valuation?
The answer to that multi-billion-dollar question is 3 letters: XAI.
XAI.
Yeah. Back in February 2026, Elon Musk made the controversial decision to merge his independent artificial intelligence startup, XAI, into the SpaceX corporate structure. And this S-1 filing is the first time the public is seeing exactly how expensive that AI ambition really is.
And how expensive is it?
The AI division alone lost $6 billion in 2025, and it is currently burning through $2.5 billion per quarter.
That is astronomical cash burn. We're talking about roughly $27 million a day just vanishing. Where is all that money physically going?
It's going straight into the massive AI infrastructure build-out we discussed earlier. The filing details a truly staggering contract with Anthropic for access to their Colossus One data center.
Right.
SpaceX is paying Anthropic $1.25 billion per month for this collaboration.
$1.25 billion per month. How does a server contract even reach that scale?
Because they aren't just renting a few servers, they are effectively renting the computational output of a small city.
Wow.
The physical cost of the power, the liquid cooling, the thousands of dedicated HBM chips from Micron, and the engineering talent required to maintain an AI supercomputer of that magnitude is astronomical.
It's just massive overhead.
And it doesn't stop there. On top of the hardware burn, SpaceX just entered into a $10 billion collaboration with an AI software company called Cursor. Cursor makes an AI-native code editor, and this deal includes an option for SpaceX to acquire Cursor entirely for up to $60 billion, with a punitive $10 billion breakup fee if they decide to walk away.
So they're throwing tens of billions of dollars at AI hardware and software, effectively using the reliable, growing revenue from Starlink to subsidize this massive existential bet on artificial intelligence.
Exactly. Reading the S-1, it becomes clear that SpaceX is no longer just a rocket company with a satellite internet side hustle. It's attempting to build a vertically integrated aerospace, telecommunications, and artificial intelligence conglomerate.
And it is all legally controlled by one single man. The S-1 confirms that Elon Musk holds 42% of the total equity in the company, but through a structure of super voting shares, he commands 85% of the total voting power.
But this dual-class share structure is vital to understand.
Yeah.
It means that public investors will be providing the billions of dollars in capital required to keep the lights on, but Musk retains absolute unilateral control over the board of directors.
He holds all the cards.
Yeah. He can execute mergers, fire executives, or pivot the entire strategy of the company without needing a single vote of approval from the public shareholders. Given the sheer scale of the XAI cash burn, that lack of corporate oversight is a massive risk factor for any institutional investor to weigh.
And we're already seeing how the market is struggling to weigh this risk, particularly through a phenomenon traders are calling the amalgamation trade. Because SpaceX is private right now, traders use Tesla stock as a liquid proxy for SpaceX news.
Right.
And the trading data surrounding this dynamic is totally counterintuitive. You would assume that great news for SpaceX would boost Tesla since they share a CEO, but it's much more complex.
It's a fascinating study in market psychology and capital constraints.
Oh.
The data shows that when SpaceX hits a major IPO milestone, like officially filing the S-1 or announcing the roadshow dates, Tesla stock actually drops an average of 4.2% over the next 10 trading days.
Which seems backward until you realize it's a liquidity issue.
Exactly. The institutional investors who are structurally bullish on Musk's ecosystem only have so much allocated capital. If SpaceX goes public and they want to buy in, they have to raise cash by selling something else.
Right, they sell Tesla to buy SpaceX.
The IPO is viewed as a massive liquidity vacuum sucking capital away from Tesla. But on the flip side, when there is news of tangible synergy between the companies, like when Tesla recently disclosed $143 million in direct vehicle sales to SpaceX, Tesla stock rallies an average of 6.1%.
Okay, so they like the teamwork.
The market rewards the physical integration of the ecosystem, but it violently punishes the internal competition for investment capital.
Which brings me to what I think is the most shocking red flag detail in this entire IPO setup. The underwriters, led by Goldman Sachs, have earmarked 30% of the total float for retail investors.
That's huge.
30%. The standard allocation for a mega-cap IPO of this size is usually around 10%, strictly reserved for the big institutions.
Yeah.
So let's step back and look at this. They're offering everyday retail investors 3 times the normal allocation for a company that is burning billions of dollars a quarter, run by a CEO with 85% unchecked voting control, all to fund a speculative AI infrastructure build-out. Are everyday investors being set up to hold the bag here?
That is the multi-billion-dollar question looming over Wall Street right now.
Yeah.
The risk factors listed in the S1 are glaring.
Yeah.
If you buy into this IPO, you are buying in at a valuation multiple of 94 times their 2025 revenue. Not profits, revenue.
That's incredibly steep.
That leaves absolute zero margin for error. If Starlink's subscriber growth slows down even slightly, or if the massive investments into xAI don't yield immediate monetizable software breakthroughs, that multiple could contract violently.
Right.
Furthermore, there will be massive lockup expirations hitting around December 2026, where early private insiders and venture capital banks will finally be legally allowed to sell their shares. That flood of new shares could create a massive supply shock, crushing the stock price.
But the institutions aren't looking at the risks. They are looking at the historical returns.
Right. You cannot ignore the institutional FOMO, the fear of missing out. The S1 explicitly highlights that Alphabet, which invested $1 billion into SpaceX back in 2015, has seen a 64x return on its investment on paper.
Wow, 64 times.
For a decade, SpaceX has arguably been the best performing private asset on the planet. Millions of retail investors have been begging for a chance to get a piece of it. The underwriters know this. The demand will likely be astronomical, regardless of the cash burn or the voting structure.
So we have Silicon Valley and SpaceX aiming for Mars, aiming for AI supremacy, aiming for a $2 trillion valuation. But we have to bring this conversation crashing back down to earth.
Back to reality.
Because while tech companies are building the future, brutal, physical, real-world conflicts are threatening to derail this entire economic narrative. We have to look at the geopolitical shadow hanging over the global supply chain. We need to talk about the escalating U.S.-Iran conflict.
This conflict is the immovable object sitting directly on the tracks of our maglev train. It's the primary macroeconomic friction point right now, and it dictates the physical reality of the global energy trade.
To give a strictly impartial timeline, based entirely on our sources, this specific conflict escalated dramatically in late February when the U.S. and Israel conducted targeted attacks within Iran. The immediate physical consequence of that ensuing war was the functional closure of the Strait of Hormuz.
And we cannot overstate the importance of that geography.
Right.
The Strait of Hormuz is arguably the single most critical choke point in the entire global energy supply chain. It's a narrow band of water connecting the Persian Gulf to the open ocean.
Okay.
When military conflict closes it, oil and liquefied natural gas tankers are physically trapped inside the Gulf, preventing them from reaching global markets in Asia and Europe. The moment those tankers stop moving, a massive inflation premium is injected directly into global commodity markets.
And right now, the diplomatic situation is incredibly volatile, and the commodity markets are whipping back and forth based on the daily headlines. Over the weekend, we heard President Donald Trump state publicly that negotiations for a 60-day ceasefire were, quote, proceeding nicely. Secretary of State Marco Rubio also noted he saw good signs emerging from the talks. That gave the market a massive sigh of relief.
It did. The prospect of reopening the strait, allowing those trapped tankers to flow, sent oil prices plunging initially. But the diplomatic reality on the ground is incredibly fragile.
Yeah, things change fast.
Because shortly after those optimistic political statements were made, U.S. Central Command conducted what they termed self-defense strikes over the weekend. They actively targeted missile launch sites and fast attack boats that were placing mines in the water.
And the response from Tehran was immediate. Iranian Supreme Leader Khamenei warned that major differences still exist and stated explicitly that U.S. military installations in the region are no longer safe. The entire ceasefire narrative was immediately thrown into chaos.
And we saw the economic fallout instantly in the energy markets. The price of Brent crude, which is the international benchmark for oil, whipped violently back up, rising 3.5% to $96.67 a barrel. Meanwhile, U.S. domestic WTI crude actually fell 2.8% to $93.89.
Why the sharp divergence between the two? If oil is oil, why is the international price spiking while the U.S. price drops?
Because the physical threat is regionalized. The international supply chain, particularly for Europe and Asia, relies heavily on crude flowing out of the Middle East. So Brent crude spikes purely on supply fears.
Ah, I see.
The United States, however, produces a massive amount of its own domestic oil in places like Texas and the Dakotas. So WTI, the U.S. benchmark, is slightly more insulated from the immediate shipping choke point in the Middle East.
But insulated doesn't mean immune. And this brings us right back to part one of our deep dive. This energy shock, this $96 barrel of oil, is exactly what is driving the localized inflation that is crushing our everyday consumer. When oil goes up, transportation costs go up. When transportation goes up, manufacturing goes up, and suddenly the price of ground beef at the grocery store is out of reach.
Exactly. The geopolitical conflict is the physical transmission mechanism for consumer despair. But what is truly staggering is how the stock market is treating this threat.
Right.
One of our sources from Carnegie Investment Council described this as a Teflon market. The broader equity indices driven by AI are just shrugging off the threat of a prolonged regional war. The bad news simply slides right off.
They are completely ignoring the systemic risks. But inside the energy companies themselves, the tension is palpable.
Yeah.
We just saw BP, British Petroleum, fire their chairman, Albert Manifold.
Wow.
The reports cite serious concerns regarding governance standards and oversight during this crisis. This sector is under immense operational pressure to navigate a literal war zone, and it's causing internal corporate turmoil. Yet the broader S&P 500 just keeps hitting new highs.
The market's blind optimism is entirely predicated on the belief that a ceasefire is inevitable and that energy prices will stabilize. If that assumption proves wrong and the strait remains closed, the Teflon will wear off very quickly.
And that leads us to the ultimate referee of the global economy, the institution that has the impossible job of balancing the AI supercycle, the broke consumer, the $96 barrel of oil, and the risk of war.
The Fed.
We are talking about the Federal Reserve.
Yeah.
And the Fed just underwent a historic, seismic regime change.
This transition cannot be overstated. The leadership change at the top of the Federal Reserve is easily the most consequential macroeconomic event of the year, perhaps the decade.
On May 22, Kevin Warsh was officially sworn in as the 17th chair of the Federal Reserve, replacing Jerome Powell. And this was not a smooth, unanimous transition.
No, it was not.
He was confirmed by a highly divisive 54-45 Senate vote, which our sources note makes it the most divided confirmation in Fed history.
And Warsh brings a profoundly different philosophy to the central bank. He was a Fed governor during the 2008 financial crisis, and he has spent the last decade arguing for a leaner, more disciplined, less interventionist institution. He has explicitly, publicly blamed the post-pandemic price surge as the biggest policy error in 40 or 50 years.
He is not pulling any punches about the previous administration's performance.
Yeah.
So mechanically speaking, what does a Kevin Warsh Federal Reserve actually look like?
It looks structurally tighter and much quieter. He favors a significantly leaner balance sheet. Mechanically, this means the Fed will likely accelerate the sell-off of its massive crisis-era bond holdings.
What happens when they do that?
Well, when the Fed sells bonds, it drains physical cash out of the financial system, which inherently pushes long-term interest rates higher.
Yeah.
He also wants to radically change how the Fed communicates with Wall Street.
In a way.
He wants fewer post-meeting press conferences, and he explicitly wants to retire the dot plots.
The dot plots.
Yeah, the dot plots are the charts where Fed officials guess where interest rates will be in the future. Warsh believes they create false certainty. He wants the market to rely on hard data, not on Fed hand-holding.
But the most controversial part of his entire philosophy might be how he actually calculates inflation. Our source from Chase Wealth Management highlights that Warsh prefers to use something called trimmed averages rather than the traditional core PCE metric.
That is the flashpoint. The Bureau of Labor Statistics calculates inflation by looking at a basket of goods: housing, food, energy, cars. A trimmed average inflation metric mathematically chops off the extreme ends of that data distribution.
Okay, so how does that play out?
So if there is a sudden massive spike in oil prices due to a conflict in the Strait of Hormuz, a trimmed average might effectively cut that data point out of the calculation, treating it as temporary statistical volatility rather than structural inflation.
So using a trimmed average is like a college student begging a professor to throw out their lowest test scores so their GPA looks great, even though they still functionally failed 3 classes.
That is a phenomenal analogy, and it's exactly why the internal workings of the Fed are currently in turmoil. Warsh could theoretically look at 96 oil crushing the American consumer and say statistically it doesn't count towards the Fed's inflation target.
Which is maddening for the consumer paying at the pump. And it's a critique that literally tore the Fed apart last week.
Yeah, the resignation.
We saw the sudden resignation of Fed Governor Stephen Millan, who stepped down in protest right as Warsh was sworn in. Millan argued that these measurement tweaks are inherently dangerous. He stated that these measurement errors have effectively reduced the real inflation target, risking unnecessary unemployment by forcing the Fed to fight what he called fake statistical noise rather than economic reality.
The internal dissent is at a boiling point. The April FOMC meeting had the highest level of dissenting votes since 1992. But Regardless of the internal academic fights, the reality of high interest rates is hitting the market hard. We heard a very hawkish warning from Fed Governor Christopher Waller in Germany recently. He explicitly stated that inflation is not heading in the right direction and warned that a rate cut is no more likely than a rate increase. The market has completely capitulated on the dream of cheap money returning anytime soon. Futures markets are now pricing in a 70% chance of a rate hike by the end of the year.
A rate hike. Just months ago, everyone was betting on multiple cuts. So if you're listening to this trying to navigate your own portfolio, what does this all mean? The market is at an all-time high, but rates might go up, and the underlying consumer is broke. How do you protect your investments in this environment?
If we connect this to the bigger picture, we have to look at a vital metric called the equity risk premium, or ERP. The ERP essentially measures the extra reward you get for taking on the risk of buying volatile stocks instead of just holding perfectly safe U.S. government bonds. According to Bloomberg, the ERP has narrowed drastically from 0.70 down to 0.17.
That is a massive drop in the reward for taking risk.
It is. Let's break down why. Right now, 10-year Treasury yields are hovering around 4.49% to 4.56%. You can buy a government bond and get a virtually guaranteed return of 4.5%.
Okay.
Because tech stocks have surged so high, their earnings yield, the amount of profit they generate relative to their massive share price, is barely higher than that bond yield. The extra financial reward you get for taking on the risk of a stock market crash has almost entirely vanished. Mathematically, equities offer very little relative value compared to bonds right now.
So, if stocks are mathematically expensive and risky, and cash sitting in a savings account is quietly losing its real purchasing power to nearly 4% inflation,
Yeah.
where do you actually put your money?
Our sources from JP Morgan suggest pivoting toward portfolio defense mechanisms that correlate positively with inflation. They're talking about real assets, physical things, commodities, natural resource equities, energy infrastructure.
Things with tangible value.
Right. If inflation goes up, the value of the copper and oil those companies produce goes up with it. They also point to emerging markets, where corporate earnings are expected to grow rapidly and valuations are actually still cheap. And finally, gold, acting as a traditional hedge against inflation volatility and currency devaluation.
Makes sense.
The goal is to ensure your portfolio can survive a prolonged stretch of stubborn inflation and expensive borrowing costs without relying entirely on the AI tech rally.
Okay, we have covered an immense amount of ground today. We started by looking at this unstoppable maglev train of the stock market, fueled by an AI semiconductor boom that is pushing companies like Micron past $1 trillion, dictating international trade flows, and funding the mind-boggling $2 trillion ambitions of the SpaceX IPO.
It's a lot to take in.
It really is. But we also spend time looking out the window at the passenger cars left behind. A historically depressed consumer struggling to buy groceries, geopolitical conflicts threatening to choke off global energy supplies, and a hawkish new Federal Reserve under Kevin Warsh that is threatening to raise borrowing costs even higher while arguing over how to even measure the pain.
It is a systemic divergence. You have a digital supercycle pulling in one direction and physical macroeconomic reality pulling in the other. Those two realities cannot safely coexist forever.
Which leaves us with one final provocative thought, something for you to mull over as you watch the financial headlines roll across your screen this week. SpaceX has set an unprecedented 30% retail allocation for its historic IPO.
Yeah.
They're actively hoping that everyday investors will step up, empty their savings, and fund their massive billions of dollars a quarter AI cash burn. But according to the University of Michigan, those exact same everyday consumers are experiencing a record low economic confidence of 44.8. They're being squeezed by nearly 4% inflation, 96 oils from a Middle Eastern war, and credit card rates that are only going to climb higher under a hawkish Fed. So here is the question. If the American consumer is historically tapped out, terrified of the economy, and struggling to afford ground beef, who exactly is going to buy that $22.5 billion retail IPO float?
Are we watching the greatest, most engineered wealth transfer from retail to institutional hands in history? Or are we about to witness the spectacular moment the unstoppable force of the AI supercycle finally hits the immovable object of a broke consumer?
It's a question that will undoubtedly define the rest of 2026. Thank you for taking this deep dive with us today. Remember, always look past the headlines, check the numbers for yourself, and keep questioning the narrative. We'll catch you next time.